In the third edition of the Wealth Creators, we are going to focus on the business of hospitality. Yes, that's correct. The area is booming a whole lot. Several stocks are doing very well, but one particular company from the depths of COVID has done phenomenally well for its shareholders and all the stakeholders is Chalet Hotels. So today I'm in conversation with Sanjay Sethi, who is leading the affairs at Chalet Hotels as MD and CEO. Sanjay, thank you very much for inviting us. Great meeting. What a wonderful lounge you have here.
Thank you.
So before we talk about Chalet, everybody has got just one thing on his mind. In the last 4 years, this sector has been one of the best performing in terms of growth. Shareholders have made a lot of money. But what phase of the cycle are we in hospitality right now in your view?
So Ajay, we came off a really poor period during COVID, and I think the ramp up after that has been extremely good. And we believe, at least I strongly believe, that the upcycle is going to be a strong upcycle for us. The visible future that I can predict right now is the supply side growth that we're going to happen. And because it's a brick and mortar business, you see supply coming in fairly early. So from that perspective, I have visibility for the next 4 years. And with that as a background, I'm very confident that we've got at least 4 years of a steady growth phase going ahead.
Also, Sanjay, what happened was that it used to be extremely deep cyclical kind of a space. 5-7 good years and then 5-7 very weak kind of year. Has over the last 5-7 years, COVID onwards, the consumption patterns also of the consumer changed, be it the institutional consumer, which is office space, corporate consumer, as well as the individual leisure traveler. Has that composition also changed a whole lot, because of which companies such as yours are dissecting the market and coming at a tailor-made solution in hospitality?
Well, true. Clearly during COVID and post-COVID, we've seen a pretty big change in the way the mindset of the young travelers is today. They're ready to spend more on experiences, sometimes at the cost of savings, which is not a great thing for a country. But we see that growing quite incrementally. And the millennial generation is clearly hell-bent on getting good experiences and living a life today as against looking for the future. And very rapidly, they're becoming a primary target audience. The Gen Z, which is even next step further from, better than millennials in terms of spending towards experiences, will probably become a target audience for the five-star hotel industry, maybe 5 to 10 years down the line.
So tell us, Sanjay, you've been a hospitality veteran for a very long time. There was a time when there were five-star hotels and there were others. But has the market also got differentiated a whole lot? For every kind of user, there's a new segment emerging, a new offering emerging. So this fragmentation is actually very good for the growth of the market.
It is. It's really good because you're giving a larger community of the travelers an opportunity to experience good quality of hospitality. And it's also creating segments within the hotel business, which in their own respective ways become the enablers for people to invest in, or investors to invest in. From that perspective, there's now a fairly large size hotel business that's available. I mean, if you look at maybe 15 years back, the total supply in India was about 40,000 rooms, the branded hotel supply. Today is 170,000 rooms. And a lot of the supply that's come in has been at the upscale to budget and economy segment. And between is the mid-scale segment. All of them have seen a lot of growth. Going forward also, I see a supply largely leading towards the mid-scale and budget.
So biggest supply is actually mid to budget, is where the big supply is coming?
Actually, if you look at the supply side, we're expecting about 9% year-on-year growth for the next 4 years. 80% of that is coming in segments that are at upscale, mid-scale, budget and economy.
And how are things looking in the luxury and the premium end?
Luxury is probably the least amount of growth on the supply side going forward. So there are two segments that are sit above upscale segment in our hospitality lingo.
Sure.
One of them is upper upscale, which is just above upscale, and then the luxury. So luxury and upper upscale combined together is only going to be 20% of the total new supply that's going to come in.
Interesting.
So clearly that's a segment that's going to be probably have lower supply side input. Demand continues to grow at double digits there. So we're seeing a benefit in that segment. Also, I think that's also because it's more capital intensive in nature in that category.
So talk to us about this entire phenomena that the K-shaped recovery, the luxury, upscale, etc. is growing very healthy and very agnostic to pricing. But the lower end, the more value orientation consumer is actually very challenged right now. Do you feel that in hospitality as well?
No, not really. I think there's enough supply at all categories of hotels. What has happened, Ajay, very clearly is that there's been premiumization of the experiences that people want. And therefore, there's been a move upward in terms of quality hotels that people want to stay.
So how, when you say that you're very fairly confident for the next 3-4 years at least, the health and the trajectory of growth is comfortable, where is that confidence coming from?
As I said, it's a game of supply and demand. We see demand staying healthy and a growth pace of demand being between 10 to 11% year on year for the next 4 years. Supply side is significantly lower, and that favorable arbitrage that we have between demand and supply
will continue.
It gives us the confidence.
Which are the regions which are really, is it all correlated to business related demand, or the leisure and travel is also?
I think it's a good mix. What's happening is a lot of the supply is actually coming in the leisure markets and tier 2 and tier 3 markets for business travel. Demand continues to be very robust across markets. So therefore, I believe the tier 1 markets will continue to do extremely well going forward, because the demand supply arbitrage is going to be larger there.
I was just previously we did a segment with one of the biggest your wealth managers also in the country, and they were telling me that up till now India has seen wealth being concentrated in 4 to 10 big cities in the country. But very convincingly he told me, Ashish Kehar of Nuvama, that next the B30 in the financial services lingo, the 30-40 cities beyond metro, they're witnessing massive boom in business and travel leisure. Can you correlate that or draw some semblances in hospitality? Are there areas of interest, or you will see evidence first and then go there?
No, I think we will see evidence and go there. That's our DNA of growth. But Ajay, what's interesting is if we're going to see tier 2 and tier 3 cities, and tier 4 actually, tertiary cities also grow, I think it's great for our business, because that's my source market. That's not necessarily my base where I'm supplying my product to the guests. If these tier 2, tier 3, tier 4 markets, people get more affluent, they'll tend to travel to leisure destinations in bigger cities a lot more, and therefore consumption of room nights across India will be stronger.
Okay, let's talk about business models which are prevalent in the industry. Your group, of course, has a massive legacy and great reputation of a very strong player in the real estate space. Then there are legacy, groups like Taj and others, phenomenal work being done, versus a lot of external overseas, players who want to come here and capture, because India is booming. Sure. How are the Indian players with Indian roots and business models versus companies who want to partner? How is the entire sector evolving right now among players?
So Ajay, there are 2-3 things that happen. One is companies which are brands, which typically are going asset light or asset right, as it's called sometimes. And then there are hotel owners like us, who actually have a capital intensive business model. We invest in the hotels, and the brands get to sign them as managers of the hotels.
So what are the pros and cons of both the business
both sides,
models?
I think the brands is, because it is asset light in nature, the fee that they get out of each hotel is significantly lower than the contribution of EBITDA to the hotel owning company. Right? As a reference point, the fee for a budget hotel per year, per room, ranges around a 30,000 rupee mark, that's all. And it can go up to 1.5 lakh rupees for luxury hotels per year. The contribution of EBITDA to hotel owners is about 25 to 30 lakh rupees minimum at the luxury end. It goes up to 55 lakh rupees in some cases. Now, let me flip this around. From our perspective, how does it count? If I was today to decide to double my EBITDA from where it stands today on an asset-light strategy and pace it as per the best hotel companies in the country, that I will sign as many hotels as them going forward with a brand in my portfolio. It'll take me 20 years to double my EBITDA. But I can do that on the back of an asset-intensive strategy in maybe 3 to 4 years.
And the popular belief is that asset light is better for return ratios. Here an evidence is that hotel owners also can have very healthy return ratios. Okay, let's go slightly deeper in that. But it also comes that not every hotel owner will be able to do it, right? It is player to player efficiency will.
I think the key elements to hotels being successful. One, of course, location. It's a primary requirement of getting that right. If you get it wrong, even by sometimes be even half a kilometer, you can be toast for life.
Clearly.
So you've got to get the location perfect and spot on. And we are fortunate that 10 out of our 10 hotels are today located in locations which do extremely well. That's one. Second, you've got to build it right. It's a capital-intensive business. If you give a free hand to everyone who's involved in the development cycle of the hotel, you can sometimes end up with a very expensive hotel on a per key basis.
Creative independence can actually cost you a whole lot.
It can. So there has to be control mechanisms. You've got to make sure that the hotels don't cost you more than about 1 to 1.5 crores per key on the development costs, and then there's land costs attached to it, which is separate.
See, land is a separate matter, but what are the ranges from, so you told us that 1 to 1.5 crore per key is the standard.
No, that's not the standard. That's what we've been developing hotels
Okay,
at.
but otherwise, what's the industry average?
So I think the industry in the 5-star luxury space is building hotels between 2 crores and up to 3.5 crores in some cases.
Wow, double of what you've been achieving, right?
So, Ajay, in a return of capital employed formula, your denominator is how much you build the hotel at, right?
True.
So if you don't get that right, and because that stays with you for life, you can very easily go wrong in this business. So you've got to get that right, and I think we are blessed that my predecessors in the promoter group in the past have been very conscious of this and have developed hotels which are efficiently designed and efficiently built.
Let's talk about
and I carry that forward going forward.
Of course, you are. I mean, you are in silent period, so I won't go too much into details of numbers. But your stated numbers, if there are any evidence, we can see industry-beating margins and good growth and all of that. Let's talk about what is the differentiated business model of Chalet. How are you achieving, very high industry margins? How are you achieving efficiency as far as average cost of room is concerned, decadal high room rates, and what is the direction it may take from here? And the cost control is the differentiating. What is the differentiating business model at Chalet?
I think the foundation of all this is that you are getting into this business for creating returns. If that's your mindset, you're likely to find ways of doing it more efficiently than others. If you get in there and for a reason that I want a hotel in this city or this location, and there's no other criteria to it, you could get it wrong very easily. So from our perspective, we look at 2 or 3 things. One is CapEx. CapEx per hotel is critical for us because, as I said earlier, it is going to stay with you for life. So the denominator on return of capital employed is determined by how much you spend per room in a hotel. You've got to get that right. And that comes out of 2 or 3 things. One, designing it efficiently. Number 2, building every square foot on an efficient cost per square foot. And that combination, and I think we're blessed with the fact that we are able to develop hotels at very efficient square foot per key. And let me give you a reference points here. Our JW Marriott Sahar was opened in 2015. Our total gross built-up area per room is about 1,150 square foot per room there. We went on to improve this further later on. I'll give you a reference later. But we were in a market where other hotels in our competitive market were somewhere between 1,800 to 2,500 square foot per room. Now, if you have a 45 to 50% advantage on your capex costs, which is your denominator of return of capital employed, which is you're going to live with for life, you've got immense amount of price flexibility. And because we're building our hotels right and they're building them well, they also continue to be market leaders. So the numerator is driven by the revenues that we crack, which is at the leading end of the competitive market, and denominator is because we build them more efficiently.
So in this equation, what is in your control? Land costs are not in your control, or sourcing?
I think land costs are also in your control. You've got to decide where you're going to build it
or not.
Because it needs to be viable. And if I was to buy land today in Mumbai and build a hotel, never be viable at today's real estate prices. So we are blessed that 60% of our portfolio is in Mumbai already.
And legacy portfolio.
And we got barriers to entry.
Sanjay, I want to talk a little more about, sweating out the asset better. Design is one part. What about other costs? We all know that whether the occupancies are high or low, a certain level of manpower is required there. What about utility costs? Because cost of operation is also a big factor. Sure. And in fact, if I may call it, facilities such as hospitality, these are the 2 biggest factors. How are you keeping it under check or under control?
So Ajay, I think 2 or 3 things. Number 1, we obviously try and sweat the land part of the real estate asset more with a very strong focus. On that front, we are, as I said, looking at square foot per key. But more importantly, if we have more FSI and the land is a larger parcel, we'd like to put alternate asset classes on that land because it does 2-3 things for us. Number one, I'm sweating my land. The new asset class is coming at zero land cost because I've already spent that for the hotel plot, a hotel building that I've spent. And number two, they become complementary because an office asset, for example, will generate demand of room nights. So in our numbers, I mean, when I look at it, I typically look at about 1 million square foot generating 30 rooms per day of demand, new demand for my hotels if the office is in that location.
So your business model is slightly differentiated. It has a very good mix of office space as well, and you would like to keep it that way in the next 2 to 3 years?
Wherever I have opportunity to sweat the asset, I will use that opportunity. And let me again come back to that reference of 1150 square foot. We are now with the new hotels at about 800, 850 per room, which is again, we're constantly improving efficiencies there. When you have low square footage of room, it is helping your denominator, as I mentioned earlier. Numerator is helped, of course, by the location, so therefore your revenue premium that you get. But more importantly, the square footage that you build tends to affect your cost very positively.
Okay.
If you're building less, your number of people required to run that square footage is lower.
Will be lower.
I can give you a reference point here. The metric that we look at in the industry is number of employees employed per room basis. Because every hotel is differently sized in terms of number of rooms. We look at this metric as a common metric. Chalet is operating at roughly about 0.93 employees per room. The industry is between 1.6 to 2.2 employees per room. At the higher end, it could be also 3 employees per room. But we've sort of institutionalized this efficiency, this productivity of employees in the system very efficiently pre-COVID and now more efficiently post-COVID.
Sure. So
and similarly, I just want to complete this, sorry for that. But the less square foot also results in the second cost that you mentioned earlier, the utility costs, right? Less area, therefore lower air conditioning bills, lower electricity bills, low maintenance bills.
But you are having a lot of endeavors, I see, as far as reducing your utility bills via smart engineering. You have a element of renewables also coming in now, which is, I saw your margins, I mean, they're like over 40-45% depending on whether you're talking about quarter or yearly. You have upward bias because of these measures are being institutionalized in the operations?
No, so look, it's a journey of constant improvements. In 2018-19 when we went public, or 19 actually.
19 January, I remember.
February, we were doing our roadshows before that. A lot of people asked us, listen, you already at very high EBITDA margins. Right. Is there any headroom for further growth? And we've grown 400 bips since then. Yes. So we're constantly evolving and improving.
But you see margins. There is scope for doing a lot of stuff.
I think there's no time to rest at any given point of time. I think every day we make an effort to improving margins.
Your last stated numbers were, again, decadal high rates, and numbers are very healthy. So I was talking to some of your large shareholders, just taking feedback before. One is getting a sense that even the QIP, your last QIP fundraise saw a very healthy subscription. One is getting a sense that the business momentum and the efforts which you are taking, and of course the industry tailwind, can double your business in 3.5 years. Is that a fair estimate to take?
Yes, for Chalet. I think if I was to look at an internal aspiration, I would like to look, and this is not a guidance in any way, but it is something that's more internal, is I would like to see us doubling our P&L in about 3 years' time from now.
So what are the 3-4 biggest areas? As a CEO, I'm sure you are a very hands-on guy, but you have business leaders in your team. But what are the 3-4 strategic areas of focus from the board level for your individual, kind of focus area where 80% of your time is actually spent on these 3-4 big focus areas?
So I think clearly my board gives me key result areas that I would deliver, right? And I think to a large extent that's a reflection of where I focus most of my time on. Driving operating efficiency is one of them. Second is growth. And on the growth side, efficient growth is critical for us. So it's not just
top line growth.
It's just not just top line growth. It is inorganic growth by adding new assets and inventory to our portfolio.
Yeah, I just saw that.
But more important than that is adding that efficiently. So look, we are spoiled by our own performance to some extent. Anything that we take on, we will take on very carefully to ensure it doesn't dilute our performance in any way. So everything that we add going forward will actually add to the margins that we have as against being dilutive in nature.
I want to talk about the Duke's asset which you recently acquired. Just for reference point, how much of your growth from here on would be organic, and are you always scouting, because your balance sheet allows you that, you're scouting for opportunistic assets where previous asset owners are not being able to run it and take it over, refurbish it and add to your growth?
So look, the Dukes, people who sold Dukes to us, the reasons are very different. But yes, our intent is to sort of elevate the property first and then sweat the asset more by adding more inventory. Just to give you a reference point again, Dukes we acquired when it required, it had 80 rooms, which needed some serious renovation. We were now expanding to 145 rooms from 80, again sweating the asset. And we're going to position it very differently.
From 80 to 145?
Yes, we added 65 new rooms. It's work in progress right now. But more importantly, we want to also elevate the asset and to be able to drive higher ARRs out of that. If you ask me what's my internal aspirations for Dukes, we were operating at about 8,000 rupees pre-renovation. Yeah. I would like to position it around the 14,000-15,000 rupee price point post-renovation.
And you see demand there?
That's the least of my worries.
So are we talking, you're at what? The run rate is about 3,000 keys right now operating and work in progress, of course. Are we talking about a number of closer to 5,000 keys operating in the next 3-4 years?
So we've got roughly 3,050 odd rooms operating right now, and close to 900 under development. So that takes us to about 4,000. I would like to see us get to a 5,000 number sometime in the future. And I'd like to basically say that at some point of time, I should be able to come back to the market and say my operating portfolio plus pipeline is 5,000 rooms. And I'm hoping it will not be too distant a future.
Excellent. Thank you very much, Sanjay, chatting with us today, talking about the industry and also telling us what Chalet Hotels is all about. Thank you so much for your time. Great chatting. Thank you.
If you like this video, then like, share and subscribe to ET Now.